Hey everyone, welcome back to Corporate Decoder, the place where we decipher corporate filings so you don't have to. Today, we're diving into a Form 8K from Damon Inc., and let me tell you, this one's a bit of a bumpy ride. It involves debt, potential stock dilution, and a whole lot of hoping for the best. Buckle up, it might get a little turbulent. So, Damon Inc., a British Columbia-based company, filed this report on February 27, 2025, about events that happened a week prior. If you're not familiar with Damon, they're trying to make waves in the electric motorcycle world. Think sleek designs, advanced technology, and a whole lot of ambition. But ambition requires money, and that's where things get interesting and a little bit complicated. The core of this 8K revolves around two key agreements with Streeterville Capital, LLC. Let's start with what they call the Second Amendment to Secured Promissory Note. In plain English, this is about changing the terms of an existing loan Damon has with Streeterville. Damon originally borrowed $6.47 million from Streeterville back in June of the previous year. Now they're changing the rules of that loan. The big change here is that Streeterville now has the right to convert the debt they're owed into Damon's stock. This is called a conversion option. Basically, Streeterville can say, instead of you paying us back in cash, give us shares of your company. This can be a lifeline for a company that's short on cash, but it also means existing shareholders could see their ownership diluted, meaning their piece of the pie gets smaller if Streeterville converts. This is because more shares are created, and you are dividing the company into more pieces. The conversion price, how much stock Streeterville gets for each dollar of debt, is based on 90% of the lowest average stock price over the 10 trading days before they convert, but there's a catch. There's a floor, a minimum price of $0.20 per share. That's subject to some adjustments. If Damon issues new securities, stocks, or bonds at a floor price lower than $0.20 in the future, Streeterville's floor price will automatically adjust to match. This could incentivize Damon not to issue stock too cheaply. There's also an ownership limitation. Streeterville can't end up owning more than 9.99% of Damon's total outstanding shares after any conversion. This kind of clause is pretty common to prevent one entity from gaining too much control of a company without making a formal takeover bid. Now let's shift to the amendment to note purchase agreement. This relates to another deal Damon made with Streeterville in December the previous year. This agreement allowed Streeterville to purchase even more Damon shares over time. This amendment is about shareholder approval rules. Because Damon is based in Canada, they were operating under the assumption that they didn't need to follow certain NASDAQ rules that require shareholder votes before issuing a lot of shares. Specifically, they believed they could follow their home country practice. Streeterville and Damon agreed that if Damon loses its status as a foreign private issuer, it has to get shareholder approval within 90 days to keep issuing shares under the purchase agreement. Okay, next up is unregistered sales of equity securities. This section explains that the shares potentially issued to Streeterville upon converting their debt won't be registered with the SEC. They're relying on an exemption that allows them to sell to accredited investors without all the usual registration paperwork. An accredited investor is basically a wealthy and sophisticated investor that the SEC believes can fend for themselves without all the protections afforded by a full registration. They're using something called Section 4A2 of the Securities Act as their get-out-of-jail-free card, arguing that they are selling to an accredited investor without any general advertising to the public. It's a common move, but it's essential to follow all the rules carefully to avoid legal trouble down the road. The report also mentions the issuance of 1,255,230 common shares to their former financial advisor. This was to settle a previous agreement where Damon agreed to pay the advisor fees in either cash or shares, and they chose to issue shares. Just like the Streeterville situation, they claimed an exemption from registration for this share issuance. Now let's get to other events. This is where Damon gives us an update on how much money they've actually received from Streeterville under the original stock purchase agreement. Damon states that they've received $3.8 million out of the total $10 million that Streeterville committed to. This leaves a remaining balance of $4.066 million, excluding any accrued interest and a specific type of purchase which we'll talk about. As of the end of February, Streeterville has purchased over 3.6 million common shares to satisfy these prepaid purchases. Because of those purchases, Damon's outstanding balance was reduced to roughly $1.27 million as of February 27, 2025. Finally, Damon reports that they have about 26.9 million common shares outstanding as of the end of February. This is important because it tells us how much of the company is already owned by the public and how much dilution could occur if Streeterville converts its debt into shares. So, what does all of this mean? On the one hand, Damon has secured some much-needed funding and has managed to reduce their debt. On the other hand, they've given Streeterville a lot of power to potentially convert debt into equity, which could dilute existing shareholders. The company is walking a tightrope. Looking at Damon's overall situation, it's a mixed bag. The electric vehicle market is competitive, and Damon is facing off against established players with deeper pockets. Damon's strengths lie in its innovative technology and sleek designs, which could help it stand out in a crowded market. But its weaknesses are its reliance on debt financing and the potential for shareholder dilution. The company is clearly still in a growth phase and needs capital to scale up production and marketing. The biggest risk I see here is the potential for significant dilution if Streeterville exercises its conversion rights aggressively. This could put downward pressure on the stock price and make it more difficult for Damon to raise capital in the future. The agreements with Streeterville could provide short-term cash, but could cause long-term problems. In conclusion, Damon is an innovative company with a lot of potential, but it's also facing some significant financial challenges. The deals with Streeterville are a double-edged sword, providing much-needed capital but also creating the risk of dilution. Investors should carefully consider these risks before investing in Damon. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate decoder videos. Let me know in the comments which company you want me to decode next.